All right, so it's 12:30, so why don't we get started? So thanks everyone for joining us. This is the latest installment in Bressler's webinar series. Today we're going to be talking about Reg BI. I'm David Buffa, and I'm joined by my colleagues Joe Calabrese and Logan Fisher. We're principals in the Bressler Securities Practice Group, where we focus on litigation and regulatory matters for financial services clients. Lucky to also be joined by John Ivan of Capital Forensics. John has a true wealth of experience in the financial services industry. He began his career at the SEC, and prior to joining CFI, he was the CCO at Raymond James and worked in senior compliance and general counsel roles for Bank of America, Merrill Lynch, Janney, and Goldman, among others. So thanks for joining us. So, as our presentation's screaming headline points out, Reg BI is here, Form CS is here, and they've been effective for a little more than a month. And while there hasn't been really a bevy or even really a trickle of new guidance that's come out over the last month, the people on this panel have been working with clients on interpreting the rules and following guidance and implementing these new rules. So while today's presentation will touch on what the new rules are and what the requirements are, we're going to try and focus on practical insights and some frequently asked questions that come up, on the road to Reg BI. So I should mention that for those that are seeking CLE, we'll announce 2 secret code words at the middle-ish and end of the presentation. I couldn't think of anything witty, so I asked my kids for 2 words, and that could have been a pretty dangerous ploy, but they were eating lunch, so you'll see what they are when we get there. All right, so here's a roadmap for today's discussion. We're going to touch on general overview of Reg BI, how we got here, what Form CRS is, and then we'll walk through each of the core obligations with some sprinkling in some insights and some FAQs as we go along. I think that there's also a chat function that the participants can use. I think you can type a question in there and the panelists will see it. So if we have time and if we can fit it into the presentation, we'll try and address some questions as they come up. All right, so Reg BI. Reg BI was adopted in June 2019 and it went effective at the end of June 2020, so a little bit more than a year to interpret the rule and implement it. Over that time, there were some legal challenges. The most prominent one was the state attorneys general and an investment advisor network filing complaints in the Southern District. It went up to the Second Circuit Court of Appeals. In essence, I think it's helpful to understand what the arguments are, just for purposes of understanding where the rules came out. In essence, the plaintiff's argument was that the SEC should have imposed a fiduciary rule and a fiduciary standard upon broker-dealers, similar to what applies to investment advisors. The plaintiffs pointed to the SEC's own study that concluded that there was a gap that could be addressed with a fiduciary standard. And the SEC essentially responded saying, well, we have the authority to determine the most appropriate way to address the gap between the standard of care that applies to investment advisors and brokers. And we feel that if we impose the fiduciary duty, one of the undesirable consequences of that is that it would essentially eliminate the brokerage services available to retail clients, in part because it would be prohibitive from a cost standpoint. So the court ruled in favor of the SEC. There are no pending major legal challenges, but there's additional issues that could come up down the road. So states have adopted or proposed fiduciary rules, and preemption issues are still in play. And at the end of June 2020, the DOL came out with a proposed fiduciary rule that is largely similar to what's required under regulation best interest, but we'll touch on it throughout the presentation. There's a number of areas where the proposed rule by the DOL ratchets up a number of the requirements that are imposed upon firms.
Hey, David. Also, a recent headline: Biden and the Democratic platform came out and said they won't repeal it, but they're certainly going to take a big swipe at it.
Right. So, and this is a really interesting topic because I think if you appreciate that Reg BI came out of Dodd-Frank, and one of the components of the rulemaking was to conduct this comprehensive study on the duty that applies to brokers and compare it to the duty that applies to investment advisors. That was all conducted under the prior SEC regime, and their conclusions were essentially that they should close the gap. And under Jay Clayton's SEC, for the reasons I went over before, they felt it was more appropriate to address it in this way, which is higher than suitability, but definitely not fiduciary duty. Okay, so what is Reg BI? So Reg BI is essentially, it's a requirement to act in the best interest, for broker-dealers to act in the best interest of retail customers at the time a recommendation is made. There's a duty of loyalty component. You can't place your interests or the firm interests ahead of the customer, and a number of requirements to address conflicts of interest, to eliminate them, and to the extent you can't, mitigate and disclose them, and a requirement to implement policies and procedures that will address all the requirements of the rule. So how do you comply with Reg BI? Well, essentially you need to satisfy these 4 component obligations. You have the care obligation, which is essentially the new standard of conduct, new standard of care. You have the disclosure obligation, and this is brand new. So this is a requirement that firms make full and fair disclosure of all material terms related to the scope and terms of the relationship, related to conflicts of interest, before or at the time of a recommendation. So that's a brand new requirement to develop those documents and deliver them. You have the conflict of interest obligation. So as I mentioned before, that's the requirement to identify and eliminate or mitigate and disclose conflicts. And then the compliance obligation, which is generally to adopt policies and procedures that implement the rules, which includes a training program. Form CRS. So I think one of the major takeaways with Form CRS is that it is not Reg BI. It was issued as part of a rulemaking package that included Reg BI, but it's separate from Reg BI. And the major difference is that Reg BI only applies to brokers, and Form CRS applies to broker-dealers and registered investment advisors. And it's essentially a 2- or 4-page summary that generally goes over your services, conflicts, fees, disciplinary history, and a description of how associated persons are paid. There's various triggers that require delivery to prospective and current clients, and so we'll touch on that later on. But Form CRS is a major component of that rulemaking package, and it has overlap with Reg BI. Okay, so before we get into the various components, just a quick overview comparing Reg BI to the prior suitability standards. There's now a broader definition of who is considered a retail client. Some of FINRA's limitations on that definition no longer apply. Reg BI applies to interactions with potential clients. There's the heightened standard of care, so it's more than suitability but not fiduciary. Where exactly it lands is subject to some debate. The new disclosure requirements, new record keeping requirements, the application of this best interest standard to account recommendations. So this doesn't just apply to recommendations of securities and investment strategies, it applies to recommendations of account types. And then an emphasis on rollover recommendations. And that's also an important component of the new DOL Fiduciary Rule. So jumping into the standard of care. So Joe is going to talk about this one. And Joe, I think one of the things that we hear often from clients and particularly from brokers is, well, best interest, it sounds a lot like just a synonym for suitability. I mean, I understand that there's more built into it, but even when suitability applied, I always acted in the best interest of my client. So is this like a distinction without a difference? Like what's actually changed here?
No, there is very much a difference. So if you step back for a second, the best interest, right, is the standard now that we all have to live with. And those recommendations have to be in a retail customer's best interest. So you have to start from the beginning of this rule parsing as to who it applies to. It is similar to what they used to call the duty of loyalty. And I think all lawyers looking at any new rule say, well, just define to me what best interest is, and then I can move on, right? The SEC did us a favor and didn't define it whatsoever. But there is very much a difference in suitability. A broker could always say, suitability and best interest, actually, if you listen to people testify, were interchangeable, right? I did what I thought was best for my client. I did what I thought was suitable. Now you really have to pull that apart. You really have to look, unpack that type of decision to see what makes sense. So, and more of a direct answer to your question is, think about a client who wants to be in fixed income, is only looking for conservative income, and you could put them into 10 different muni bond funds, right? All of which would be suitable. But the question is, of those 10 muni bond funds, which of them are actually in the client's best interest? You may find out that actually only 2 of them are in the client's best interest. Well, how do we get there? And we'll talk a little bit more about this in the next slide. But while cost is not always a factor, that's the first place you look, right? How is the broker being compensated? How is the fund being compensated? Are there overlay fees? Are there features of this fund that aren't necessarily in the client's best interest? So of course, with mutual funds, we talk about A shares, B shares, C shares, and how long people are going to hold their investments. Now you could say, look, you can't just say anymore, they were looking for income, and here were 10 stable funds in order to do that. Now you have to break those funds apart. So it is very much different than what it used to be. Included in best interest, though, besides just say an investment itself, are investment strategies, right? So is a series of transactions better than one? Sadly, there is no, I say sadly, more frustratingly, there is no explicit definition of what a series of transactions are. And then finally, under the same unpacking, so to speak, we also have to look at account types, right? So whether or not, and in particular, we look at rollovers, 529s, margin cash versus IRA, all sorts of things like that. So you really now have to, it's not just the investment, it's how are you getting people into them and in what vehicles. So for a basic example, in the whole world of IRA, if you have a client who's in a company-run 401k, most people, of course, when they leave that company, we'll say to them, come to us and sit in our IRA. We can manage it better. There may not be a reason to do that. If that fund is still being managed, and it's being managed in a very inexpensive way, as those funds usually are, those accounts usually are, they may not need to be in an IRA that you can manage, that you can charge a fee for. So, and every client's going to want something different. Some clients going to want you to manage it. Some clients going to want you to pick up the phone every time you do something. Others want to be very involved. So now all of a sudden, it's not just the what, but the how. So I think these are all things we're going to have to consider.
Mm-hmm. And David and Joe, in addition, in addition to the comparison of care standard for suitability, of course, you have to add on what Logan and I are also going to talk about: disclosure and conflicts. So for the whole package, especially for plaintiffs in the future.
Absolutely. I mean, it's going to be not just looking at the the inner workings and expenses and costs that apply to a fund in the context of, is this particular one in the client's best interest, but is there potentially a revenue sharing arrangement between the firm and that fund that even if this is in the client's best interest, there's an implicit potential for bias that is going to run afoul of the rule. So there's a lot of different areas where folks can trip up.
And on that point, which I think is an important one, the way that we always got out from under on that is, provided we gave the right disclosures to the client on that issue. So if you look at a confirm for particular types of different funds, is one transaction 8 pages worth of confirm because of all the disclosures, and then we point them to the prospectus and talk about all the that's not good enough anymore. Just disclosure is not enough. Now you have to look and see if those disclosures add up to something. So it used to be, honestly, a lot easier. Now we're going to have to do a lot more work.
Yeah, absolutely. And just to confirm, are you guys seeing the slide progressing? Are we now on slide 11?
I can see slide 11, yeah.
Yep, you're good.
All right. So Joe, in the context of, I mentioned before that, this new rule expands the definition of retail customers. What is the commission said about the application of this rule? Like, who's within scope, and what is the major component I think that's different from the FINRA rule when it comes to high net worth individuals?
Yep. Sure. So definitionally, a retail customer is defined as a natural person. Thanks for giving us nothing. We understand that. Or the legal representative of a natural person. We generally don't see that as much. We generally deal with clients on a one-to-one basis. But if you're talking about trustees and trusts, things like that, you have to take that into consideration now. And it's either of those, I'm going to call them entities, not people really, right, who receive a recommendation for any securities transaction involving any strategy or investment from a broker-dealer. And the part two of that is, though, who uses the recommendation primarily for personal, family, or household purposes. So they're cutting out the business end of this a little bit, which is useful for us. They're really trying to protect the retail client. But if you have, for example, an account in the name of someone's LLC, but it's really just a family account, you still have to look at whether or not that person's a retail client or not. A lot of people will do that just to protect themselves legally. I've seen a lot of cases where the name of the account is XYZ LLC, but it's really just a family fund. So, but again, you're looking at people, families, or household. As to the change in the definition, now, as to what you asked, under FINRA's old definition, a high net worth individual, which would be excluded from something like this, was $50 million or more. They were considered institutional clients. Now they're not. So that dollar figure, which I have to be honest, not a lot of people spend a tremendous amount of time looking at, because retail cases don't always involve people like that. That's out the window. So now you really have to stick with natural people, legal representatives who receive a recommendation for a personal, family, or household purpose. Actually, this is the one place where I think it makes it a little bit easier, because it takes away a lot of the exceptions.
Yeah, this is a case where what we're going to talk about primarily the retail business and all of the ramifications, but several of clients, and I'm sure several of your clients as well, actually kind of went out of their way. If it was a family office-based ultra high net worth business, they actually changed their entire business model because of Reg BI. They either went out of their way to categorize the accounts, make sure there were no retail accounts, or one client actually went to make sure all they were doing was quote unquote showing product, and they went out of their way in training to make sure they weren't making recommendations. So it's a big deal for a tiny little segment.
Yeah, absolutely. I think that there are a number of firms that we spoke to that were institutional oriented and said, well, Reg BI is not going to apply to us because we don't do retail client business. But when you got down into the guts of it, you realized that a number of these firms had opened up what we'll call like accommodation accounts for folks related to the clients that they're working with. And the nature of those accounts, the firm wasn't making recommendations, but there's a number of steps you can take to be prudent to make sure that you're not going to run afoul of the rules. And we have talked to firms about sending letters that are, as you said, John, explicit in defining what the scope of the relationship is. But I think this is just one of those examples that seems straightforward, but it requires every firm to pause and look at their client base to make sure they're not running amiss. Okay.
So we're gonna drill down a little deeper on what some of these definitions mean. Legal representatives are non-professionals or non-regulated individuals, just like I said a moment ago, executors, conservators, POAs, things like that. The definition of recommendation is interesting because whether or not it's a communication, whatever it is, it has to be a call to action. So it's not if someone just says to you, hey, do you think 529s are a good idea? If the answer is yes, you're okay, right? That's a conversation, right? Do you think mutual funds are a better idea than, say, owning individual stocks or ETFs? And if the answer is yes, and here's why I think, and here's why, that's a conversation. But if you say to them in a more tailored communication, right? Well, as a matter of fact, our firm has this type of mutual fund or this type of 529 that invests in certain states. Once you start talking about things and saying, and if you'd like to take a look at that, we can show you what that looks like. This might be right for you. Now you're approaching that, calling somebody to action. At the end of the day, listen, here's what I think you should do. Why don't you sit down and why don't we talk about it? As soon as they pick up the phone and say, yeah, what can you do for me? Now you've got to, I think, at least in my opinion, we haven't seen obviously these in hearings or proof yet, but that's where you're crossing the line. So you're going to be very careful about, well, we've got something that can help you out. As soon as you start encouraging somebody is where you really start talking about recommendations. So just remember that phrase, call to action. Call to action can be a very, very low bar. So you just have to be very careful when you're prepping your witnesses, reading your broker's emails, reading their system notes, what exactly they said and how they said it. The old, yeah, we talked about it for 10 minutes is not going to be an answer that you can live with, because it's not going to fulfill what you have to get the answers to. So that's why we have to encourage people now, of course, more than we ever have, to be very detailed about how they take their notes and do their interactions or their emails, particularly, because now that call to action is going to be embedded somewhere that you have to be careful.
Right. It's going to be a facts and circumstances type determination, and when your job is to have those interactions throughout your day, countless times over the course of a month, it's going to be difficult to tap into your recollection, especially when compared to a client who's having much fewer of those types of conversations and might remember things differently. So documenting and having a process around it's going to be important.
A number of our clients took this opportunity, which we do, and as you advise clients and internally, for a big new rule to actually take some real serious action that they've always been wanting to take. And in this area, sort of the note taking, we're going to talk about how do you document whether something was in the best interest. This whole area of we've got to get better at documenting these conversations and aligning portfolios with what we're recommending. The firms rightfully said we're using Reg BI as our, as the reason that, that's what we're going to use to go out and say, this is the reason you've got to do this and whatever, which is very classic for what we do for big new rules.
Right. And I think, one of the takeaways of this definition of retail customer, and we see this same, the use of the recommendation as the trigger point with delivery requirements, et cetera, is, unlike a case of an investment advisor who has an account opening, you enter into an investment advisory agreement, and you have that defined moment where a number of these delivery requirements apply. With the brokerage relationship, making the recommendation the linchpin for kicking all of these obligations in, as we've just discussed, it's much more of a gray area, and supervision around it is presenting its own challenges that we'll get into. All right, so Joe, I think just for timing reasons, why don't we skip ahead to recommendations of account types, just talk about the IRA rollovers and how that's been highlighted by the commission here.
Yeah, so look, anything to do with an IRA has always been closely watched by regulators and panels when they look at recommendations around that, because retirement, for the average meat and potatoes investors is what we're involved with, and damage caused as a result of a bad recommendation might not be something they can recover from. So factors that we're asking people to consider under this rule is, first of all, look at the retail client's investment profile. And don't just look at what got papered over when they moved from the other broker, right? I see plenty of people in their 70s and their 80s who are moderate capital appreciation speculation. And you look at that and say, who is paying attention when someone, checked that box? And it's not going to be a defense at trial when you say, well, look, this is the way it was papered 10 years ago and we haven't changed it. We've been talking to it for 10 years. You have to be very clear about what you're doing with that. You have to talk to your potential clients about the potential risks, rewards, costs of an IRA compared to an existing plan. And that's something we spoke about just a few minutes ago. It's a little repetitive, fees and expenses, level of service available, things like that. We covered that a little bit. look at it this way. No matter what happens when somebody moves their account over to you, you've got to be that much more careful when it's qualified money. You've got to be that much more careful when it's an IRA, because the regulators are looking at that much closer.
Yeah, and if your account opening agreement is potentially not going to withstand scrutiny and litigation, John or Logan, I mean, what have you seen some firms do around IRAs in particular? If they've done anything specific or put any new requirements in for supervision?
Logan, you want to take off? I can do the whole panel on it if you want, but why don't you lead?
You know what? I'm still working through some tech issues here on my end, John. I'll defer.
Right, so actually, we were just actually talking about this with a client yesterday. Look, the fact patterns on these IRA rollovers are fascinating. In this case, a whole series of clients potential clients were riffed, so they are no longer, happy with their former firm for a whole number of reasons. But in any event, the idea was went out and solicited them to roll over their former 401ks into IRAs. I think a lot of firms in working through DOL, which we'll talk about a lot, as the firms using some of the controls and processes they put in place for DOL, were in pretty good shape here. I think they were saying, hey, it's no brainer. We went through all that angst of whether it was a recommendation, education or advice under DOL. We have all our forms. We required, once we got to advice, we required to get Form 5500s or 404s to have some sort of idea. At the end of the day, the supervisor for this client basically got it. He basically said, look, and he really did a really good job and walked through, as they walked through the checklist, and basically saying, look, these are we're going to have a mutual fund advisory account. It's all institutional shares. We're at 19 basis point cost basis. It looks like the 401k was somewhere between 35 and 50. Their administrative and management is way less than us. Client has to understand that. Client basically has to understand we're going to be charging you 80 beeps, but you're going to get all these other things on the checklist that's on the slide. And the better you do it, the better you will be in litigation. And now I think most of our clients went out of their way in the Reg BI disclosure document to highlight this as a very big conflict of interest. So you'll have that additional disclosure. A lot of firms put it right into their rollover forms. I've gotten all this stuff, and I got your Form CRS, which is spelled out right in Form CRS when we get to that. So those are some of the things we've been seeing.
Yeah, and I mean, rollovers obviously were a huge focus of the old DOL fiduciary rule, and now they've appeared again in BI, and in the proposed DOL fiduciary rule, as it's currently written, one of the areas where they've ratcheted up requirements over BI is around rollovers, and if the rule is adopted as it's currently written, there'll be a requirement to document the rationale for recommending a rollover to a client, why it's in the client's best interest. And so, that's one of those things that I think in the first instance you can look at and say, okay, well that makes sense. And if you're going to make that recommendation, you should be able to justify why it's in the best interest of the client, why it's different. But I think that one of the takeaways from that is that the practical reality is that over time, advisors and brokers are going to have to go back and reassess that rationale and make sure that it still applies, because if 10 years down the road, they're no longer in the same type of program that made sense for them to change originally and roll over their account, that could present an issue if it comes up in litigation or in a regulatory context. Yeah,
we do a lot of data analytics, and I don't want to be in the case where they multiply that lower cost over 5, 6, 7 years and make that as a starting point for their case.
Yeah, and speaking of costs, so Joe, so is this like, does Reg BI mean that every recommendation now has to be the lowest cost option for the client? Can you ever recommend an investment that costs more than a reasonably available alternative?
You can. You know, here's another devil in the details, though, right? So the answer is cost is not necessarily a factor. Not necessarily only the lowest cost investment can be, or strategy can be recommended, but there's a requirement that cost be part of the analysis. There's a requirement that higher cost alternatives can be justified, and you also have to look at whether or not there are reasonably available alternatives. You then, of course, run into the conflict of interest issue with proprietary products run by the firm. So keep this in mind, though. While no, cost is not a determinative factor, what do you think a regulator is going to look at that first swing, right? If you say cost is not always a determinative factor, what do you think the plaintiff's bar is going to do the first time you show them a mutual fund where that trail is going to be higher than another one? Well, all of those good things about that fund, I promise you, will be the last thing in that conversation. And finally, and we're certainly not talking about trying these cases today, although that might be a good idea for another seminar, it's a question of what are arbitration panels going to latch onto? So I think it's dangerous to say cost is not the only issue, but I think you really have to be very, very wary of that.
I think particularly in the context of this reasonably available alternatives requirement,
yeah.
You know, I think there's going to be a lot of hindsight-based analysis if you don't have a good documented reason for at the time you made the recommendation picking one over another if cost is not, if it's not the lowest cost option for that client.
Yep. And Joe, the example you brought, which was a great one, of the muni income funds, factor in also a lot of firms have a straight municipal bonds, and what's the ongoing cost of a well constructed muni bond ladder versus a muni bond fund, which of course the two business departments have fought over for forever. Yep. So there's that as well. How far out do you go with reasonably available alternatives?
And I can hear the answers to both questions, right? It's rote with the answer to that questions, right? Greater diversity into the market. Like I can hear them both sides of people's heads, so to speak, answering that question. The point is that you can't live with those two answers anymore. Right? That rote response that you relied on people to give you when I asked that question, when you prep them for cross or direct, now has to be modified. And getting people out of that loop, I have to tell you, is going to be a challenge. I think it is.
So John, how have you seen clients grapple with this reasonably available alternatives requirement? I mean, is it something that firms need to generate, lists or have some kind of other process put in place to meet this requirement?
This is one. There's some aspects of Reg BI where you kind of cluster around solutions that are very sort of close to each other and pretty self-evident. This one's got a wide spectrum. I mean, there are some vendors out there already that have proposal tools. So firms, primarily ones with relatively small product shelves, limited offerings, and that type of a business, they really have a sort of a proposal tool that, based on that limited product offering, really does kind of solve a bunch of things at once. It does really go through and have a justification for comparing things in the fixed income space or the other spaces. So that's sort of one end of the spectrum. By the way, they also deliver, they also deliver form CRSs before you can even speak and things like that. So there's a nice vendor technology solution. I think very few firms have been able to implement it because of all the reasons that you can imagine, all the practical reasons that you can imagine. I think in the vast middle of our clients anyway, has been a real focus, which we've always done, on sort of where is the real risk in the recommendations, and for those, that's where you're going to make sure you really are addressing reasonable alternatives. And it had the benefit because a lot of the firms already had documents and processes in place. So when you do a 1035 exchange, you already had a process and a document to explain why I'm going from this variable annuity with a surrender charge into that one. We just talked about rollovers, the same thing. And another high profile one is, why did you choose an advisory, non-discretionary advisory account versus a brokerage account? A lot of firms have inserted a checklist type of document which will address the key reasonable alternative in that case is, should I do brokerage for a low amount of commissions, or should I do a non-discretionary advisory? So those are some of the spectrum we've seen on a reasonable alternative. Now, the big one which everybody is talking about, which we haven't seen a great solution on, of course, is, okay, that open-end mutual fund that is mirroring an index versus versus an ETF. 6 years from now, when that open-end fund goes south, the plaintiffs will be gathering around that one big time.
Absolutely, and I think you touched on it. In the way that I've seen firms address this, you've got technology, and for maybe smaller firms that can't afford the resources or the lift to implement new technology, taking things like pre-existing 1035 exchange forms and adopting them to include rationale for why a mutual fund is being recommended, and the broker writes in the symbol for the 5 or 6 funds that they consider. Okay, so why don't we move ahead to, I think we touched on a lot of these FAQs and observations. Let me see if we have some questions from the audience. Okay, so one thing that's come up, if my client calls and asks me to execute a trade that I do not believe to be in that client's best interest, and am I, as a broker, required to do anything? So I think this example, it's a registered broker-dealer, not a duly registered broker-dealer investment advisor. So a client, unsolicited investment that you don't believe to be in the client's best interest, does it run afoul of the rule if the firm executes that trade request?
I think you run into that anytime a client wants to do something they shouldn't do, right? So rule number 1 is, you don't have to do it. You don't have to take their business, right? As long as you give them the opportunity to do that somewhere else, you have not run afoul of the rule. However, and I'm not suggesting we send business across the street. However, if you do decide to execute that, it's very much the same thing, that besides just simply marking it as unsolicited, you have to, like we talked about before, you have to document the conversations. You have to, I would say, send a confirmatory email if the client emails, making sure that all of that's down pat, because in 5 years from now, you are not going to remember that conversation. And a confirm that says unsolicited is meaningless. So, but I tell brokers all the time, you don't have to do stupid things because someone asks you to do it. Think about it before you agree to do something. Mm-hmm. But if you do, you got to document.
Yeah. And as an expert for Joe, I would say there was no recommendation. Therefore, Reg BI, Reg BI wasn't triggered. But the next question will be, how many unsolicited transactions in that ticker were there on that day? So,
yep. Fair enough.
All right. So the next obligation, and it's kind of incredible. We've got about 25 minutes left for this, so we'll try and kind of walk through some of these basic aspects a little bit more quickly. So the disclosure obligation and Form CRS. So 2 different things. So let's walk through them separately. Reg BI disclosure obligation. Before or at the time of recommendation, full and fair disclosure of all material facts related to the scope and terms of the relationship and conflicts of interest. So, one of the ways that I've understood this is in the context of investment advisors with their ADV Part 2 brochures. So, investment advisors have a comprehensive document that goes through essentially what's required by the Reg BI disclosure. And now that obligation is effectively being imposed upon brokers, broker-dealers. The complicating factor is that unlike investment advisors that have what I'd call more concrete triggers for delivery of the ADV at certain points in time, or when the investment advisory contract is entered into, as we talked about before, the Reg BI disclosure obligation is triggered by a recommendation. So we actually got a question from the audience here that touches on this. Does that mean that every single time you make a recommendation to a client, you have to re-deliver your Reg BI disclosure packet? And for some context here, I think we've seen the size of these packets ranges from, some have been 5-6 pages all the way up to 100 plus. So it's it's potentially a lot of material. And the answer is no. So I think the standard that's in the accompanying release is that you need to provide this Reg BI disclosure to a client before the recommendation, but close enough in time so that it's useful. So every single time you make a recommendation, you don't need to re-deliver it. But I would think that if you delivered it at the outset and then continue to re-deliver on an annual basis, or earlier if there's a material change to the Reg BI disclosure packet, that would satisfy the timing and disclosure requirement. But that hasn't been like an explicit rule that's come out.
Yeah, I agree. All our clients are in that space. With the, as you said, with the unusual event, there might be a material change in your business that actually went along with the recommendation that wasn't in the previous disclosure. But you already covered that. If there's some sort of amendment to the disclosure you previously made.
And you guys might have seen this in in your experience. I think some firms have taken the tack, and I might be getting ahead of ourselves here, but in terms of if this Reg BI disclosure packet is not required to be delivered at every single recommendation, but when you look at Form CRS, there are additional delivery triggers that require delivery to the client whenever there's a rollover recommendation, even if the client's a current client. How are you seeing firms address those differences? Are they setting out a matrix for their brokers to follow and say, oh, well, if it's a current client and I recommended this, then I have to deliver this piece, but not this piece? Or what I've seen is some firms are taking the tack that everything goes every time any of these delivery triggers are set. So
plus quarterly updates. So they're going to give at least 10 to 20 copies to that arbitration panel. So, but I think that's probably it is the risk appetite of the firm. We had one client, unfortunately, who built their matrix, their delivery matrix that you're talking about. They built it before the FAQ came out, because the FAQ came out and the SEC basically said, okay, Joe, you opened up we sent you one last week, and in the normal course, we got around to, we're going to do some covered calls, and now let's open up an option agreement, to go along with what we've been talking about all along. The SEC basically said if you delivered one within 30 days, then you're okay. A lot of firms had built their matrices and tied it to their delivery technology before that came out, but there is that little safe harbor, 30-day safe harbor, that will be subject to further guidance and maybe even some other developments. But there is a little 30-day out there as well. But I think most firms want a belt and suspenders that we're going to talk about record keeping of these deliveries. I think most firms want a belt and suspender with at least one good welcome package, so they can always point to it and hope that the regulator will say, okay, they did get one technical foot fault, that they didn't get one 31 days earlier.
Yeah, it's I think the 30-day safe harbor is it's helpful, because having to redeliver the CRS every day or every week, if triggers continue to occur throughout the relationship, that's an onerous requirement. But at the same time, it's an additional factor when you have so many factors already built into the equation. So, when you're advising your client on what's going to make it the cleanest way to achieve compliance, given all of the additional factors that are present, it's understandable that some have said, look, we're just going to require everything to get delivered. And in the context of paper, that might be really burdensome. So we're also going to require electronic delivery at certain points in time that are signed up and part of the account opening process. But again, I think this is something that the delivery and the client experience is still something that remains to be seen in terms of how the SEC is going to further drill down on it. Okay, so this slide, just going over what the components are of the disclosure obligation. The one I want to focus on is capacity and material limitations. So capacity means whether you're acting as a broker-dealer or a registered investment advisor. And one of the complicating parts of this is when you have duly registered firms, but not everyone at your firm is a duly registered individual. So if you have a duly registered firm, but Mary is registered as a broker, but not as an investment advisor, and the disclosure packet covers everybody, so it doesn't talk about Mary specifically, and Form CRS doesn't have any specific disclosure about her, how will she satisfy the disclosure obligation when she meets with the client? I'll open it up, John or Joe. Have you come across this before? Because I've seen one way that it's been addressed.
We had one client who had it. We basically put it in the firm's disclosure that basically outlined the scenario. I think firms determined to make that depending on how big of a swath of Marys they had. If they had a couple, they didn't. But if they had a good chunk of their registered reps were not registered and qualified as both, they actually put that in there and indicated that in talking and discussing you should talk with, pointed the client they should talk with a registered rep, and then in the training side of it, guided that singly registered person to cover it further, further cover the disclosure of capacity.
I've seen two ways that it's been addressed. One is in this general disclosure document, essentially setting an assumption. So if you're interacting with somebody at our firm, you should assume that they are only registered as a broker unless they tell you otherwise. And then the other is, for firms that only had a few people that were only registered as a broker, like an individual disclosure for that person that they could use in their dealings. So why don't I'll just quickly touch on CRS. So I think the takeaway with CRS is that summary document, and it has different triggers compared to BI's disclosure document. So the disclosure document, as we said, triggered around recommendations. Form CRS is also triggered around recommendations, but on an ongoing basis, you have to continually deliver it to clients whenever you recommend that they roll over accounts or open an account that's different from an existing account. So what we see that generally is in the context of you have a client who's got brokerage accounts with you and you're duly registered and you recommend an advisory account. So you'd have to redeliver a Form CRS with that recommendation. Okay, so as we said at the outset, this is a topic that I think each of these components we could spend an hour or 2 hours easily talking about all the different considerations. But I think we should jump ahead to conflicts of interest, because that's something that I think a lot of clients are focused on, and there's a lot of questions around different ways to address this. So actually, here's the first code word for CLE credit. It's delicious. Makes me pretty happy about the sandwich that I made. There you go. All right, so I think that this conflict of interest obligation, we saw like a wide range of the way that people address this based on the size of the firm and how sophisticated their systems were. But John, what have you been seeing?
Well, we actually have 11 minutes, so we can cover it. That's pretty good for a Reg BI panel. I'm not sure why the SEC put conflict of interest third in the order, for not just for panelists, but it really does, if you think about it, it really informs the disclosure obligation, and then it really interacts with the due diligence in the CARE standard. But anyway, it is third, and we did get to it. For a vast majority of our clients, this is the third or fourth bite of the apple with conflicts, some way or another. As you said before, they're duly registered. So as an investment advisor, ADV long ago was amended to deal with important conflicts of interest. In 2013, most of our clients either participated in or were informed by FINRA's conflict of interest report and survey. And then, of course, DOL had an important conflict of interest obligation. I think for a couple of weeks there was a requirement to name an individual as a conflict czar right everywhere with DOL. And for some of our clients in the municipal space, in the muni advisor world, there's a conflicts of interest section that is very, very similar provisions to Reg BI's conflict of interest. So basically, I think I can take the slide here. First of all, conflict of interest is just almost anything. I mean, there's lots of discussion. Is it material? Is it a financial conflict? Is it the firm versus the customer? Is it the registered rep versus the customer? By the way, this is a firm-only obligation. SEC was smart enough to say, individuals, you don't have to create policies and procedures, but they're greatly impacted by the conflict of interest. So I think the next slide, the first words are kind of the most important, and that is implement policies and procedures. So this is a separate policies and procedures requirement within Reg BI. We'll talk about the overall compliance obligation. So this makes it very similar to AML. It makes it very similar to ISPIA, insider trading, non-public information, where those are statutory requirements to have policies and procedures to deal with an important topic. And a lot of the regulatory, and we'll see how it goes in litigation as well, a lot of the regulatory cases, as you know, there's no underlying conduct. The firms get sanctioned in AML for just not having the right policies and procedures. And they do the same thing in insider trading. Unfortunately, I've been very close to that on a number of cases. So this is a very important new requirement, because I'll talk about how firms developed it and how some were far along. But this is now something that is important in and of itself to put this package together. And it sounds easy, but it's kind of not like it's not like another WSP. It's not like a standard of care, suitability, WSP. It involves different things that you have to pull together in your policies and procedures. So important to keep that in mind. But basically, it's right there. You have to have a policy and procedure that where you can identify conflicts, feed into the disclosure obligation, mitigate them, or eliminate them, depending on the facts and circumstances. And the conflicts are generally at sort of two levels, whether it's the firm conflict, and those are met primarily by disclosure. And then there's those conflicts that actually impact the registered rep making that retail recommendation. And those are the ones that need to be either eliminated or mitigated depending on the circumstances. And of course, on the slide, everybody is very aware of the one that got all the attention, and that's the high pressure, short time period sales contest for a particular product. So everybody sort of immediately went away and did away with all those. The devil is in the detail on whether we've had a number of clients, who had things, there's still things called quotas, bonuses, non-cash compensation, that are. You'll help me out with some additional examples that are perfectly fine, but a lot of firms, kind of scared off by those buzzwords. So.
I think one conversation I found myself having a lot, at least at the initial, at the outset of Reg BI, was that it's not a requirement to eliminate or mitigate or disclose. It's eliminate or mitigate and disclose. So I think as Joe mentioned at the outset, you can't just disclose it and move on. And I think going through the process of evaluating your conflicts, particularly if you're a smaller firm that hadn't had to do it or didn't take the time to do it with the DOL rule, really informed your disclosure packet. So you're right. I think the ordering of it ended up being a little, the better way to do it is to start with conflicts. Right. So what are some methods that you've seen for mitigating conflicts, particularly in the, I think in the compensation area is the main focus?
Yeah, there are, and by the way, putting that package together with an existing DOL framework that was already in place, or somebody starting brand new, I think that's fodder for another panel or something. But it is important. There's a lot of existing processes that go into it that you really have to pull together. So. On mitigation, you're right. The compensation is really the big one. Firms fell into two categories. We did it all. We levelized. We had what's either called levelized compensation among products. We levelized it out. Some called neutral factors. So the same $25,000 basically of an investment. The registered rep is going to get paid the same thing regardless of product. But then it's important that there's differential compensation because it is much harder. It takes a lot more time to sell an annuity than it does a mutual fund or a stock or a bond. So the ability to justify that differential compensation is very, very important and part of the conflicts of the whole conflicts package that you'll put together. A lot of firms did time and complexity studies where they said, yep, there's 24 forms in a variable annuity, there's 14 in a partnership, there's, here's the extra steps in this type of a product, so they could basically justify and assign what was not levelized but continued to be differential. I think the one we hear.
I was going to say, so level fee compensation is not required under Reg BI, but where you have differential compensation, you got to be prepared to justify it, essentially.
Right, and disclose it. I think in all of I think we all read. The great thing today is you can, in about 10 seconds, you can start to read firm XYZ's Reg BI disclosure right on your iPhone, right? So you go broker check, CRS, and you'll get the form CRS right on your iPhone. You read that. It's got a link to the Reg BI disclosure, and within 10 minutes you can be reading their disclosure about this very thing, which is the range of compensation for different products, very explicitly disclosed by firms.
I think that's something we're going to see. Yeah. Like advancements, changes to the technology, the ability to interact with customers and make these disclosures.
The headline, by the way, of course, is mutual funds, where with each major firm comes out capping that sort of A-share compensation somewhere in the 3.5% to 4% range. How sophisticated the firms are doing it, what kind of technology do they have? There's a big spectrum out there, but that's kind of where they're clustering at the far end of the scale. Some firms are using clean shares. completely. So there's no upfront compensation. What are they doing in their with their commissions on those? You know, they're disclosing that as well. So that's the one that's got all the attention. Mutual funds.
Absolutely, I think we're seeing that, and on the revenue sharing side, we're going to see changes as well. So we've only got a minute left, and we're going to cover compliance obligation. No, so I'll just touch on the compliance obligation. The takeaway from this is that I think across the board, regulators have come out and said in this first wave of exams, they're going to ask for your policies and procedures, and they're going to want to see how you trained your field. So this is absolutely not a throwaway type, obligation to just develop policies and procedures. This is the first thing that FINRA and the SEC and OC are going to want to see when they come through the door. So, as I mentioned, unfortunately, we're at the 1 hour mark. I know everyone would like to spend probably the whole afternoon chewing these topics over. I'll give the second code word. It's sandwich. So the first was delicious. Second one, sandwich. Before you guys sign off, I would like to highlight that we have another webinar coming up next week. It's going to cover expungement, which, although most of these FINRA hearings have been administratively delayed, expungements are still going on. You can see every week there's a number of expungement awards coming out. So next week, at the same time, there'll be some good insight into that. I'd like to thank John and Joe for their time and their insights. And I know Logan's still out there somewhere trying to log back on. So thank you, Logan. But thanks everyone for joining us. We really appreciate it, and hope you found this informative. And obviously, we could have a second one to go over the remaining material. So thank you very much.
Thank you. Take care.
Thanks so much, David.